Good evening, everyone. Time for another silver update. This is the weekly chart of the US dollar versus the Indian rupee provided by netdania.com. You can click on the link below. Now you can see on this chart the very clearly rising trend channel. This is the Indian rupee losing value against the US dollar. Of course, as the number of rupees it takes to buy a dollar rises, that means the currency is going down in value. So we've seen a lot of activity by the Indian government to try to restrict gold imports, and that is feeding back into silver, and that's going to be a big story moving forward just because the tiny amount of silver that's produced in the world uh, is just a very small amount compared to gold. So with the restrictions and taxes on gold imports, it appears that the Indians are starting to turn to silver. Now we're going to look at this idea that the Indian government has bought into, that the cause of the current account deficit, the CAD, is the predilection that Indians have for buying physical gold. I don't think that that case can be made. But before we do that, let's look at an article about the Indian silver demand. Will Indian silver imports reach a record in 2013? This is from Silver Investing News. Like most commodities, silver has had a tough time these past few months, having fallen from close to $30 in mid-April to its current price of $19.32. However, good news for the white metal has recently arisen in the form of Indian silver import figures. In a note published last Friday, Eric Sprott and David Franklin state that after importing just 1,900 metric tons of silver in 2012, India has brought in 2,400 metric tons of the precious metal in just the first 5 months of this year. That is significant given the fact that India's record for silver imports recorded in 2008 is 5,000 metric tons per silver seek. Why the surge in imports? In terms of precious metals, India's claim to fame has long been its status as the world's biggest gold consumer. It's gained that title largely because people in the country have limited access to banks, and according to Sprott and Franklin, quote, owning precious metals is synonymous with savings and security. However, at present, taxes and import restrictions are making it difficult for buyers to get their hands on the yellow metal. Seeking Alpha Director contributor Dante Caruso elaborates on those measures in a recent article, commenting that in May the Indian government raised the gold import duty to 8% from 6% as part of its, quote, drastic measures to redirect gold investment back into the economy. Further, lending against gold, including gold jewelry and gold ETFs, has been restricted, while Reliance Capital and All India Gems and Jewelry Trade Federation are attempting to curb sales of gold and gold-related products. As a result, quote, it would appear that the Indian gold trade has moved offshore to get away from those factors, while the majority of Indian investors, excluding larger investors, are gravitating toward silver, Sprott and Franklin said. So if there isn't going to be this tax, it makes perfect sense. We know that silver is tremendously undervalued compared to gold, with the 9-to-1 ratio roughly coming out of the ground, and we're still hovering around 60 and above for the gold-silver ratio. But I wanted to examine this thesis that the Indian government is proposing, that gold is the cause of their current account deficit. And I think you'll see after we look at the facts here that that is really just a fallacious argument. So let's go over to an article from the Asia Times. This article is India's Problem Blacker Than Gold by Kunal Kumar Kundu. And if you look here, what he cites is that the issue is not gold imports, but it's actually oil and coal, it's energy imports. So let's read some of this. Having said that, gold imports in the 12 months to March this year actually declined 4.75% from previous year, falling in all but the third quarter on an annualized basis. For the full year, India's non-gold imports remain stagnant. What is significant is the spurt in oil imports, which rose 10.11% during this period, even as India recorded its lowest GDP growth in a decade. The rising volumes of oil and coal imports are two major reasons why India's current account deficit deteriorated to worrying levels. Now you can see here the blue is imported crude and the red is imported coal. You can see a steady rise in both of those, a big breakout in the coal. The drastic increase in import of these two components can be linked to the woes faced by India's power industry. During 2012-2013, India's average monthly deficit between production and supply of power was as high as 7,000 gigawatt hours, the highest in 3 years with the states of southern India, etc., etc. So this is talking about imports of oil and coal, and again, in another article, I don't have that in front of me, but the statistic cited was that gold only represents 10% of that current account deficit. So let's look at some facts about who imports gold and what the current account deficits are. So I want to take you to this CIA World Fact Book to start with. This is very important because this is a country comparison of current account balance. So this is a list. I don't know if this is a list of all the countries in the world. You can see it's 193, but this lists them by their current account balance, and you can see that China is on the absolute top, and the United States is on the absolute bottom. And the bottom the United States is on is absolutely phenomenal. You can see that figure. That is nearly more than 5 times higher than the next highest one, and of course that is India, followed by Brazil, Canada, Turkey, France, United Kingdom, Australia, the European Union, Italy, South Africa, Indonesia, Spain, Poland, and Greece. So those are your big losers as far as current account deficit. Now let's look at the big winners, and you can see that China is on top with Germany in second place, Saudi Arabia, Japan, Russia, the Netherlands, Norway, Kuwait, Switzerland, Qatar, Singapore, Taiwan, Sweden, and Libya. So the first thing that comes to mind when you look at these figures would be the initial impression is that probably the more healthy economies are up here at the top, and the less healthy economies are down here at the bottom. That generally holds to be true, although it's not an absolute. But let's keep that in mind when we go over and look at the countries that import the most gold, because remember, the argument from the Indian government is going to be that it is the predilection of the Indian people to buy physical gold to protect themselves from inflation that is causing the current account deficit. Now, the other thing you want to keep in mind is that you can see that the rupee is rapidly losing value against the dollar. Now, if you think about current account deficit, trade deficit debates in the United States, they've always centered around the fact that the cure for the horrible trade deficit that the United States runs has to do with allowing the dollar to fall in value, and that's going to cure this. Now, if that's the case, then why is the Indian government so concerned about this drop in value of the rupee? Wouldn't that naturally counteract the trade deficit problems by having the currency lose value, and that would work itself out. But we're going to find out that's not the case at all, that trade deficits don't have anything to do with gold buying, and they have a lot more to do with poor fiscal policy by governments. So let's look over at the top 10 gold buyers. Now, admittedly, this is from 2011. It's china.org, so it's older information because it's from 2010 figures, but by and large, these are the same countries that are the largest gold buyers today. So you can see in the top 10, number 10 is Russia. Number 2 is the United Arab Emirates. Number 3 is Vietnam. Now that's very interesting. Vietnam has had some issues with the government trying to restrict the buying of gold as well. The next is Saudi Arabia, followed by Switzerland, Turkey, Germany, the United States, China, and India. So when we put that together with the trade deficit figures, we can see that there's simply no correlation at all. Here we have China, Germany, Saudi Arabia, Russia. Those are 4 of the top 10 gold importing countries. Now, if we go down to the bottom of the list, the United States and India are also in that top 10 list, and they are at the exact opposite end of that scale. So it's pretty evident by comparing those figures that the amount of gold that is imported by a particular country has absolutely nothing to do with the trade deficit. The trade deficit is established by what a country manufactures. So let's look at the very strong countries and try to account for why they're strong. Let's look for the weak countries and try to account for why they're weak. China, it's very clear the reason why China is so strong on this is their manufacturing. China is the world's manufacturing powerhouse. They manufacture just about everything nowadays. If you go to Walmart, you're going to see about 90% of what you buy is actually manufactured in China. Germany, of course, as well, is probably the world's second most powerful manufacturing country, even though it might not be on a numbers basis, certainly for the population and the productivity that they have. Germany is way up there on the manufacturing level. Next you have Saudi Arabia, and of course that's going to be the largest oil exporter. So their oil exports put them up at the top of that list. Then Japan is again another very powerful manufacturing nation. They export a large number of manufactured goods. Russia is an energy producer, an energy exporter, and then we have the next ones, which are some of the European nations. The Netherlands, I can't account for that one. Norway, again, they are an energy exporter. Kuwait as well. And Switzerland, of course, is a financial power. Qatar is oil exporter. And Singapore and Taiwan are both very strong. Singapore is a strong financial power, and Taiwan is a exporter, of course. So those are the top of the list. That's what they have in common. The two main themes are that they are either manufacturing nations or they are oil exporting nations, and a couple of financial powers as well. Now, if we go down to the bottom, we find the United States, and apparently the latest spin is that the United States is going to be a very large exporter of energy products. I have some serious doubts about that. India, of course, has a serious problem with their exports. That's the reason why we have the current account deficit. It has nothing to do with gold. You can see that Brazil is in that category. Now, that's very surprising for me. Apparently, the government is not in a very good position as far as fiscal restraint. Canada is surprising to see them at the top of the list considering their exports to the U.S. And then Turkey, that's another one of those that was in the top 10 gold importers. Then we've got France, the UK, Australia, the EU, Italy, and then there's Spain and Poland and Greece. So these definitely appear to be the weaker countries, even though the U.S. dollar is increasing temporarily. Of course, that's an exception to all these rules because it's the world's reserve currency, so you can't apply these rules that apply to the others. So it's clear from these figures that the argument that the Indian government is making, that it is the buying of gold by their citizens that's causing them to have a current account deficit, is clearly a bogus argument. It has nothing to do with the citizens buying gold. The reason why the citizens are buying gold is because the value of their currency is rapidly depreciating. That's because India has run a very poor fiscal situation, and they are also being very inefficient in the way they deal with energy. So the conclusion that we have to bring out of this is that governments will always try to restrict the free market. India has now attempted to restrict the importation of gold to satisfy the demand from her citizens. That is causing a feedback loop into silver. How long until we see a increase on duties and taxes on silver? I don't know. The silver is such a smaller market that it may have to happen very, very quickly, but that may have a very, very large impact on the price of silver as we move forward. And we'll talk to you next time.